Good afternoon, ladies and gentlemen. Thank you so much for coming. Today we have a great privilege to have the founder of the flagship library Mistakes in Edinburgh and the keeper, Russell Napier. He's going to present to us on a topic that's quite controversial and interesting, capital management in Europe in an age of financial repression and the slow death of the euro. Not a title that inspires a lot of optimism, but perhaps these days it's better to be a realist than an optimist. This is something that we will be trying to do as regularly and as often as possible at Library Mistakes. Invite intelligent people to share their insights and wisdom with us. For those who will be watching this via our YouTube channel, the way to find more information about the Library Mistakes is to go on the web, www.lomlausanne.ch. The catalog is there, and the recordings of all the previous speeches and presentations are there, so welcome. And so without further ado, Russell, the floor is yours. Thank you.
Boris, thank you very much. It's good to be here in this missionary outpost in Lausanne for the Library of Mistakes. I picked the book up at random. Well, not quite at random from the shelves, because it's one I hadn't seen before, and I thought I'd seen all of them, Boris, but this one's called The Art of Money Making, so I thought, well, I definitely need to read this one, and the subtitle is How to Get Rich. But I thought, actually, the dedication is even better, because it's kind of about Boris as well. It says, to the million who believe in the value of personal experience, but admit that much can be learned from books. There we go. That'll be you and me anyway, and hopefully everybody in this room, and hopefully everybody who's watching. Now, as Boris said, this is a kind of controversial statement, and it refers to the euro. It doesn't refer to the European Union. And I think one thing that you could perhaps think about is this. The European Union is the hull of the ship. The question is, when the hull of the ship is in question, it's what you jettison. I don't know, that's probably a French word, I'm not sure. Jettison, what you throw overboard to secure the ship, to save the ship. And I'm going to run you through what I think will be thrown overboard to save the ship, that is the European Union. And that is effectively the euro. And the consequences for you or anybody else of managing capital anywhere in the 27 states, what that means, what has to be done now to save the ship of state or the ship of the EU. The second slide just tries to put it, I try to, rather than be an academic and lead to the great big punchline at the end, let's have some punchlines at the start. Here's the fundamental problem with where we are today, not just in Europe, but in the whole world. We have lived in a world where, at least in theory, the supply of money and credit was something that was within the control of the central bank. But the central bank was responsible through basically utilizing interest rates, but they have other tools in terms of capital adequacy ratios, risk weighting of assets, other tools in which they tried to control the growth rate of money. But we're past that now, so this is the fundamental issue that you probably aren't going to read on the front page of the newspapers. But that's over. That doesn't exist anymore. The power to create money is falling into the hands of the governments. And of course the reason that we gave it to the central bankers is the governments weren't very good at it. That is the reason we had a Paul Volcker, because the governments just weren't very good at it. Now it's going back again. Now that's a problem for the United Kingdom, it's a problem for the United States, it's a problem for Japan, it's the same problem for everybody, but it's a bigger problem for Europe. Because when those powers go to government, where are they going? Now if they all go to Brussels, it really isn't a problem, because they go to one unified, centralized place. But if they go, and we're just talking about the euro here, so we're talking about 19, we're not talking about the 27. If it goes back to government in the euro, it's going to 19 different governments. This power to control money, this power through regulation to control the movement of capital, and that's the fundamental problem I'm going to talk about this evening, is how can you have a single currency in a world where we're devolving power from one central bank, the European Central Bank, to 19 governments. So if you like, the problem's the same everywhere, but at least when the power shifts, it shifts to one government in Washington DC, one government in Tokyo, one government in London. But now that power is shifting back to 19 different governments. And I just list 4 of the powers here that will change money, monetary policy, credit policy, and your investment, which are going from central banks to government. And I'm just going through them briefly because I'm going to talk about them in detail through this presentation. Just 2 days ago, the government of Germany guaranteed, I think it was 63 billion euros of loans to German energy companies. So they're going to the banks and saying, lend this to German energy companies and you cannot lose money. And that is a continuation of a policy that not just in Germany, but across Europe, across the world was in place from the interruption of COVID. You commercial bankers, go and lend money to people and you won't lose any money. And for the first time in history, we watched bank credit grow through COVID. And we are now watching, again, bank credit grow, whatever Europe is going through at the minute, probably is a recession. We're watching bank credit growing again. This doesn't happen. It shouldn't happen. It's not the way bankers work. Well, the way bankers work is, what's the famous quote about bankers? Somebody who won't lend you an umbrella when it's raining. You know, that's what's supposed to happen. You know, they'll only lend you an umbrella when the sun is out. Not anymore, because it's not your umbrella, it's the government's umbrella. Your risk is underwritten by the government. And that's the fundamental core of monetary policy. When I say this, I mean, there's lots of books in here that will attest to it, but no one really believes me that most of the money in the world is created by commercial bankers. It is not created by central bankers, it is not created by governments. And if you don't believe me, and most people don't, go to the Bank of England website, right, just type in Bank of England, how is money made? And the Bank of England explains that it's all made by commercial bankers. So the central bank tries to control the growth of bank credit and money by using interest rates, by using credit capital adequacy rules, risk weighting of assets. But what just happened in Germany? The government came in and said, you're the commercial banking system, lend the money. Don't listen to the central bankers, lend the money. And that's what they did during COVID. And that's the revolution that people haven't got. Now the consequences for the euro are huger than anywhere else because you've got 19 governments who can do this. This is not controlled by the European Commission. This is controlled in Rome, this is controlled in Paris, this is controlled in Berlin. It's controlled at the state level. Now one of the ways that I could be wrong about this whole thing is if somehow it was controlled from Brussels. If it was Brussels that was guaranteeing the bank credit of the German banking system, if it was Brussels that was guaranteeing the bank credit of Italy, but it is virtually impossible for Brussels to do that. It simply doesn't have the balance sheet to do that. As you know, we do have these joint European bonds now, but everybody knows that the European Commission simply can't guarantee that because it's such a huge amount of money. It's already into the hundreds of billions. It will be in trillions. 25% of all corporate borrowing by the Italian banking system and the Spanish banking system is guaranteed by their governments, not by the European Union. And believe me, the European Union isn't going to jump in and guarantee this credit. So where I'll be wrong is if somehow the European Commission gets the power to guarantee all this, they control it. They say, the German banks, here's what you get to lend and we guarantee. Italy, here's what you get to lend and we guarantee. That's a centralised control. That can mesh with the European Central Bank and the Commission together. But that's not what's happening. What's happening is each individual government is making that choice. And we'll come back to some evidence of that. And then we have this issue called yield curve control. I think most of you here in finance, and you know what a yield curve is. It's the government risk-free rate right along the maturity spectrum from 1 day to 30 years. That's the yield curve. Now, we have lived in a world where we expect that to be determined by market forces, and yet it isn't, not anymore. In my opinion, it's been distorted for many years anyway by Chinese buying, reserve accumulation in Asia, and then it was distorted by quantitative easing, and now it's going to be distorted by forcing savings institutions to buy government bonds. So we simply go to the savings institutions of Italy and say, look, bond yields are 3, we can't live with 4, you're buying at 3. No questions, you're buying at 3. I'm the regulator, and I'm making you buy at 3. Who made that decision? It wasn't ECB. It wasn't the European Commission, it was the government of Italy. The government of Italy will ultimately determine the yield curve of Italy, and the government of France will ultimately determine the yield curve of France. For what's the alternative? The alternative is that the European Central Bank does it, and its balance sheet grows to the sky at a time of high inflation. That isn't going to happen. That's a recipe for hyperinflation. Is the European Commission going to do it? Doesn't have the balance sheet. Not yet anyway, so as I said, I could be wrong if suddenly the European Commission has this huge balance sheet to do this. So where are we? There's slightly more than 19 people in this room. Where are we in a single currency if you can determine the quantity of money and you can determine the yield curve, and we have 19 different governments doing 19 different things? Do we have a single currency? And that's the problem. I don't think we have a single currency, and that's just two of the policies. When you get into this, what has the German government just done? It said, you know what, banks, there's only a certain amount of money you can lend. Did you see all these guys on this side of the room? They're in the energy sector and they're getting it. What does that mean for you? I mean, if they're getting it, you're not getting it. This is the politicization of credit. This is the government saying, this are the people who need credit and this is the people who don't need credit. Now that doesn't really work in a single market, because the reason we tried to do away with all of this and why there are rules at the core of Europe is that this is not good for competition, equal competition within the single market. Suddenly maybe all these German energy guys are deeply competitive because they're getting really, really cheap capital. And if we have 19 governments choosing which industries they want to back, the industries that get the really cheap credit are going to be massively able to outcompete. Let's pick a German firm. It's going to be able to outcompete a French firm or an Italian firm because they're getting really cheap credit. So if the government gets into the business of pushing credit around to their politically favoured firms, and let's be honest about that, for all politicians everywhere in the world, politically favoured industries sometimes are people who pay the most money to the politicians or their parties. You know, when you politicise this flow of credit, you can corrupt it as well. But that's not really compatible with a single currency. The European problem is it's not going to one government, it's going to 19 governments. And then the final one, and the one maybe which is of most interest to everybody here. So let's say I am Germany and you are the rest of the European Union. And your governments are handing out credit guarantees and lots of euros are being created. Those euros are fungible anywhere in Europe, they're fungible in Germany. What happens if they start flowing to Germany? You know, if the growth in the supply of euros starts going 5%, 10%, 15% because we're making Italian, Spanish, French banks lend a lot of money, will Germany accept that these euros being created through political will, not by the European Central Bank, centralised control breaking down, will they permit those to flow across the border? My opinion is they won't. And I don't mean it has to be Germany. But if you, a government of Italy or a government of Spain, are creating so many euros that it's affecting inflation across Europe, then why would other governments permit it to happen? So that's the sort of the menu for what we're going to talk about tonight, as to why all of these things that are happening in the United Kingdom, Japan and America are actually much more problematical for the single currency. So I want to put this in a bigger context now, which is financial repression. So if you look at the chart on page 2. Now, I'm doing a presentation in Europe, and this is a chart in America, so let me explain why that is. We don't have really good data for Europe, going back to World War II, on the three big components of debt. And the three big components of debt are the government, the household sector, and the corporate sector. So I could show you nice charts of France, Germany, the United Kingdom, back to 1945, like this chart. But it would only be for the government. It wouldn't be a very good synopsis of the entire debt in the system. But fortunately for America, we have that data. And look what happens if you go back to 1945 and look at the total debt to GDP ratio for America and where we are today. We are so far above where we were at the end of World War II. Now, I can only guess at what a chart of French numbers would look like, but they would certainly start way up here. And then they would come down and down and down, and now they're back, and they're almost certainly above where they were at the end of World War II. and that would be the same for the United Kingdom. And it's not because the government debt to GDP, I mean it's up a lot, but it's not because government debt to GDP is higher than it was at the end of World War II, but it's because private sector debt is very high. At the end of World War II, we really didn't have very much private sector debt. Remember what had come before World War II? A Great Depression. What was the one thing you learned in a Great Deflationary Depression? Don't gear. So we hadn't geared through a depression. Debt was dangerous, people didn't do it. And then of course you had a war, which was a command economy effectively, and we didn't really have debt in the private sector. Debt was war bond drives, and that was funded by the government. So even if we had this for France, certainly the United Kingdom, we're almost certainly back at a new all-time high. Now that, I think, is what conditions and makes forecastable the future. The only question I think you have to ask is, what are they going to do about it? What's the government going to do about this? Because we've now had 2 recessions, well maybe now 3 recessions, and when you get to that stage, there's so much debt in the system that you get mass defaults with a possibility of complete financial collapse. And we saw what they did in 2009. What they did in COVID was even bigger. Remember what happened in COVID? Basically they said everybody can have credit. Or as it said, I think it was the Queen who said in Alice in Wonderland, everybody has won and everybody must have prizes. Nobody goes bust. Everybody gets credit. That's the lesson of COVID. And that's the lesson of this mess we're in today. Have I got any tangible example of that? Yeah, sure. The CFO of Commerzbank, whose name is Bettina Orlops, I think is her name, speaking 3 weeks ago, was asked, look, you know, lots of people in Germany could go bust. Why are you still lending to them? And she replied, because the government won't let them go bust. In other words, this isn't a private sector risk anymore. We know that this is a public sector risk. This is much bigger than what happened in 2009, because bankers are now saying there really isn't anybody we can't lend to anymore, because ultimately the government will pick up the tab. And that is why we have credit rising through what is very probably a European recession. Let's have a look at where we are with this debt to GDP ratio. So I've put in all the figures for all of Europe that I can get. This is from the BIS. And then just a couple of kind of comparators for you. And I put Switzerland in because I know you're interested in Switzerland. And it looks very high, but you know why it's very high, which is because of this, the way mortgages are treated here and the way you get to deduct your interest expense if you have a mortgage. You know, there's a structural reason why it's quite high in Switzerland. Not all these countries in Europe have that same reason. So here they are. You see we're where we were probably about 280% of GDP at the end of World War II, if we got a reasonable number. France is currently at 361. And the one I want to put in all of them, so you can have a look at them, but the one I really want to draw a contrast between, because this is the big problem for the euro, is France and Germany. When the euro was set up, France and Germany's debt to GDP ratio were almost identical. I mean, they were almost exactly the same. The 2 countries' gearing was almost identical. And now look at them, 361% to 205%. And that's the problem. How do we run a single currency policy with the right interest rate, the right level of inflation for both of these countries? Because one of them, Germany, does not need to have its debts inflated away. Because 205% is perfectly manageable. And why do we know it's perfectly manageable? Because that's where Germany was in 2012. 2009, the debt ratio went up. Sovereign debt crisis in Europe, the debt ratio went up. And then from about 2012, Germany's debt to GDP ratio trended downwards, all the way to 2019, because with the levels of growth that Germany had from 2009 to 2019, and the levels of inflation it had, which were really low, that was enough. It wasn't a huge number, but when your debt to GDP ratio is relatively low, you don't need particularly high nominal GDP growth to bring this under control. So I would argue strongly that Germany really doesn't need inflation. With perfectly reasonable normal levels of inflation and growth, that number will come down. But France does. I can't really find an example of a country with 361% of GDP that got its debt under control with low inflation and moderate economic growth. So how do we square the circle for France and Germany in a single currency? Because if you read the newspapers and if you read the textbooks, they'll tell you the ECB has an answer to this. The ECB can't have an answer to this. Well, either the answer is very high inflation, but will Germany put up with it? And not just high inflation next year, but the year after, and the year after, and the year after. Because to get 361% to something manageable, which would be less than 250, closer to 200, is going to take about 15 years. That depends on the level of inflation. But if real growth is relatively constant, and let's be optimistic and say it's 2.5, the inflation you kind of need here is something pretty constant around 6 or 7 for 15 years. Now maybe the people of Germany can put up with that, maybe they can put up with that. They put up with a lot so far. But ultimately that's the sort of number you as the ECB would have to create to save France. And we're going to talk about how difficult it's going to be to create a single policy that serves everybody. Now you'll notice there's some others in here with very high numbers. Belgium, Netherlands, these are to some extent almost like offshore banking centres. I'm not so concerned about them. A lot of people borrow in the Netherlands, corporates, European corporates borrow in the Netherlands, even though the cash flow that supports them doesn't come from the Dutch economy. It comes from across the whole economy. Not so concerned, but you know, Spain is still working out its problems from the sovereign debt crisis, 294%, Italy 282%. These are average levels for the world, but the world is too high. So everybody has the problem, but the problem is not, the problem for Europe, once again, what makes it unique is that it's got 2 different countries in there, the 2 biggest, with radically different numbers. Now that might be true for Alabama and New York, but Alabama and New York settled this problem in 1865. It's called the Civil War, and they just accept that. Now, I'm not forecasting a war in Europe. I'm just saying that these are sovereign states, and we've got to ask ourselves, will they accept the wealth transfer that would be involved in this if you were going to try and inflate away France's debts. So this is the other problem that Europe has that nobody else has. If you're in a unitary state, it is perfectly accepted. I live in what is currently a unitary state, which is the United Kingdom. There are fiscal transfers to Scotland. Everybody roughly seems to accept that. Will it be accepted in Germany? Because it doesn't, or in Europe, because it's not fiscal transfers per se, it's also a monetary transfer. Financial repression, which is what we're about to talk about, is a very simple thing. It's a transfer of money from savers to debtors. When debt gets too high, that's what's going to happen. Now, when you do that in any society, whether it's Switzerland or France, it creates problems. You're taking money from wealthy people, giving it to debtors, there's going to be some social friction. You're taking money from older people, you're giving it to younger people, there's going to be some social friction. This creates social friction. But in Europe, you're actually taking it from one state and giving it to another state. That's the problem. This is not just an intergenerational wealth transfer. This is not just a transfer of wealth from capital or savers to debtors. This is a transfer of wealth, if you try to do this, from Northern Europe to Southern Europe. Now you, as Europeans, will have to ask yourself whether you think that's going to happen or not. Let's just turn over to page 5, because part of the pushback is, well look, these debt to GDP levels are not relevant, interest rates are so low that it doesn't really matter. So what we can look at instead is what's called the private sector debt service ratio. And to make this kind of simple, it's the percentage of your income, anybody in this room, that is used to service debt. That's the simple way to look at that. Now that includes the interest you pay, but it also, we've got something in for the amortization of principal. So we assume you're paying back a percentage of principal, you're paying the interest, and this is the percentage of your cash flow that will service the debt. So this includes households, and it includes corporates, doesn't include the government, private sector debt service ratio. And the reason these numbers are important is that even though interest rates are at rock bottom, these numbers are really high. So how do we know they're really high? Because we can look at the history, we got the data going back to 1998. And what that data shows is if you've got a level above, say 20%, more than 20% of private sector income is needed to service debt, and interest rates go up, that's when you've got a problem. So you don't absolutely, essentially have to have a problem, but there's a real probability of a problem if about 20% of your income's already servicing debt and suddenly interest rates go up. Now look at these numbers. And these are the ones, this is just where I can get the numbers. And first of all, what's really going to surprise you is Italy. Italy's got one of the best numbers in the whole of Europe. And that is because the private sector of Italy is grossly undergeared. I'm sure there are Italians in this room who can explain it. The way I explain it is that a lot of the corporates are owned by families, and families are more debt averse. And secondly, a lot of Italians inherit the family home. And I think in a lot of places in Italy, property is pretty cheap. So for whatever reason, Italians on a personal level are much more conservative than the Germans, which is the next one up. Clearly their government is not conservative, but at least in the private sector they're somewhat conservative. But let's jump to France. It's double. The percentage of private sector income needed to service debt in France is double Germany, double Italy. And this is where interest rates are going up. So the question is, what are we going to do about that? If rising rates in Europe are necessary to combat inflation, where's the pain really going to bite? And it's going to be in France or Belgium, the Netherlands, much more so than it's going to be in Italy. So I'm not saying that Italy doesn't have a problem, because it clearly has in the government sector. But if you took all these books, a lot of them are on debt crises, and say what percentage of debt crises are in the government sector, and what percentage are in the private sector, it's at least 19 out of 20 are private sector debt crises. A public sector debt crisis, the inability of a government to pay back its debt, is actually quite rare. It's not rare if you borrow in somebody else's currency, but if you borrow in your own currency, it's pretty rare. So as interest rates go up, I think we're all focused on Italy, because obviously there's a huge pile of government debt. But let's not forget that that's called the risk-free rate, and that you, the private sector, will have to borrow at a premium to that. And what concerns me is France, and particularly the French corporate sector. Can the French corporate sector afford rising rates? And if we're going to see a private sector credit crisis, is it perhaps going to be first in France? Is that where it's going to come before it gets to Italy? French rates are also going up. All of this is important, because what is the response? So most people look at the data and go, oh, there's going to be a great big credit crisis in Europe. And I look at it and say, there isn't going to be a great big credit crisis in Europe. What you have to work out is the government response to this. What is the government going to do if long-term interest rates start going up in France and the French private sector starts defaulting on its debt? They're going to do something. They're going to stop it. So the next chart runs through the possible government options if this all starts to unfold. How do we solve the problem of too much debt? And there are 5 answers here. And obviously I'm going to tell you that the last one is the important one, but let's just go through these. So one answer is austerity. So the government stops borrowing and actually pays back its debt. Now, we are watching today what governments are doing in Europe in this crisis, and they're borrowing more. And if we jump back into COVID, what did they do in a crisis? They borrowed more. And if we jump back to 2007, 2009, what did they do? They borrowed more. Now, I don't see any appetite whatsoever for austerity. That debt to GDP comes back simply because the governments pay it back. And there's very little evidence of that. I mean, the only time it really happened was the United Kingdom after the Napoleonic Wars. And that was a very different world, because in that world, in the 19th century world, when a government stopped killing people, it stopped borrowing money. You know, it didn't have a national health service, it didn't have social security, and if you weren't killing people, then you weren't borrowing money. And the government of the United Kingdom paid it back. They also took an empire, which helped secure some of the money to pay it back. But not since that period of the world when politics was different and the world was different, not since then do we really see governments basically paying back their debt. So I think austerity is very unlikely. There was a chap in the United Kingdom who tried this. His name was George Osborne. He did about 2 years of that, and suddenly he was out of office. So I think it's unlikely, and there's no evidence at all that governments are going for that. Now, the one we have to hope for is really high real growth. You know, I'm saying that nominal GDP growth has to grow very high to get debt to GDP down. But wouldn't it be fantastic if that was low inflation and high real growth? Because you can get high nominal GDP with a low inflation and a high real growth. Now, the issue with high real growth is it's a combination of working age population growth and productivity. And we don't have working age population growth. Actually, we have the reverse. And COVID seems to have accelerated that. So we're going to have to run hard to stand still, and some countries might be better than others. America's always in a better position because of its high levels of immigration, legal and illegal. And then productivity. You know, there are governments who think they can do things about productivity, but I think productivity is effectively too strong to say in the gift of the private sector. But the private sector drives productivity. It's private sector innovation that drives it. So we can hope, and frankly we can pray, that there's going to be high real growth. But it's difficult to forecast it, and difficult to say. So you need to look out there and tell me where this great product, now it could be nuclear fusion. You know, one of the best things that can happen for productivity is a collapse in the energy price. That usually is good for productivity, not always, but usually good for productivity. So let's hope something comes along. But once again, you're the government, what are you going to do? You're going to sit back and hope? Are you going to sit back and say, look, this debt thing, we just think that something's going to come out of the private sector to solve it? Well, that's not the way politicians tend to work. So I don't think they're going to sit back and accept it. Another way you can reduce your debt is default. Well, we tried that with Lehman Brothers. Didn't work out so well. That was default on the private sector, but default on the government sector, the Bank of England did some numbers on that. If the government defaults on its debt, GDP contracts by 7%. One man's liability is another woman's asset. So you start defaulting on your liabilities, you're destroying someone's balance sheet. And that is highly dislocative, very dangerous, as we saw with Lehman Brothers. So I don't think it's going to be default. Hyperinflation is always an option, and we know countries not that far away from here that have gone for it. And that is just a social and political lottery. It was Keynes who said, not one man in a million can forecast the consequences of hyperinflation. It's a massive redistribution of wealth that he obviously thought he was the one man in a million, by the way, but there are social dislocations from this, which you're very familiar with, which we're all very familiar with, and which politician would throw that dice down the table? It's an incredibly risky way to go. So that takes us to financial repression, which is what I think we get, and that's the challenge for the single currency, which is how do we find, if I can steal something from J.R.R. Tolkien, one ring to rule them all? How can we find one form of financial repression in 19 sovereign states that is going to rule them all? And I think it's impossible, and that's why this presentation is called The Slow Death of the Euro. So let's look at some of the data, which I think already shows the problem here. So we're now looking at bank credit growth in Europe. This is on page 4. Sorry, you've got different page numbers from me, I think, so that doesn't help. Let me read out the title. Banks, growth in corporate loans, February 2020 to June 2022. And this is now through at least a recession and a half, because obviously we went into recession when COVID came. We're now probably going into another one. Look at the expansion in bank credit. Not what you expect in a recession. But the second bit is the percentage of the bank credit guaranteed by the state. So in Germany that's about 40%, in France it's about 70%, in Italy and Spain it's way over 100%. And some, the reason these are flagged up is the last people I did this presentation said your numbers are wrong, because how can Italy only have added to corporate lending of 36 billion, but 185 more billion is guaranteed by the state? Well, it's easy. If I'm an Italian banker and you're my existing customers, when you come to renew, I put you onto the government guarantee program. So my aggregate growth isn't there, but I'm kind of morphing and sort of pushing all of you onto the government. Why wouldn't I? Because I can get rid of all this risk by getting you guys all onto that program. So, and as I said, 25–26% of all the corporate credit in Spain are at least now guaranteed by the state in one form or another. This is financial repression. I was discussing earlier on with someone, how do you know if the state's building a new system, a completely different system than the one we live with, how do you know when it's going to start? I think this is the evidence that it started. This is the evidence that it started in 2020. Because if the state's involved effectively in getting the banks to create credit, and in the process create money, the central bank is redundant. Now that's a big word, redundant. Impotent may be another word we can choose for the central bank. So why do we spend so much time talking about it? And I'm here to try and answer questions, but that's actually one of the questions I can't answer. Why are we spending so much time talking about central bankers when it's quite clear that the governments are taking this power away from them? that they're becoming impotent, which is not a new thing, it's an old thing, it's happened before. And yet we are not prepared to accept the reality. I'm doing a presentation tomorrow night in Neuchâtel, and the question I was asked is there a threat to the independence of central bankers? I think you can't ask me that question, because that's not even the answer is there is no independence of central bankers. It's already gone. It's already gone. It went in 2020 when we discovered the power and potency of guaranteeing this. It's the magic money tree. You may remember the Prime Minister of the United Kingdom, Theresa May, once said, "There is no magic money tree." No, there is. Remember what this is. This is not government debt. This doesn't go on government debt. You don't have to raise any taxes to cover this. You don't pay any interest on this either as a government. This is a contingent liability on the government. So if one day the French guarantee of 149 billion, if one day that comes due, if all these private sector corporations default on the 149 billion, then the government has to either tax people for the money or sell bonds. But until that day comes, this isn't even on the balance sheet. It's a contingent liability. So this is the magic money tree. I wrote in 2020 that they were going to shake the magic money tree. People said, okay, but that will stop. Of course it will stop. And then there was another emergency, and there was another emergency. And we keep finding emergencies that mean this has to continue, and this is the new normal. And that's the problem for Europe that I began this with, is that we've got 19 different countries who can, as you can see from this, have various degrees of activity in terms of these, and therefore various degrees of money creation. Now what I'm going to ask...
Sorry, so this is the fundamental issue, the difference between the price of money and the quantity of money?
Yeah, so there's a focus at the minute on the price of money. I mean, the number one thing on the front page of the newspapers is how high are interest rates going? And what you need to think about is the interest rate is really the accelerator on the car. But it isn't the car. What the car is the quantity of money, the total amount of money in the economy. And historically, the central bankers, by pushing on this pedal, could kind of lift it and kind of slow it. But it's been severed.
And so is the crux of the issue that normally when the price of money goes up, you'd expect the growth and the quantity of money to slow down,
Yeah.
or God forbid even to go negative,
Sure.
and yet now, with the price of money going up, you have the quantity of money just unscathed, continuing to sail right along and growing.
Yeah, that's the fundamental problem, is that link between this pedal that you push on and this is severed. In my opinion, it's severed. It's severed because the governments are guaranteeing the bank credit. So we just spend our time focusing on this pedal and not, I think maybe a better analogy is the one I've done before is a coach and horses. So the central banker is the coachman or coachwoman on the coach, and the commercial banks are the 6 horses that pulls the coach. And interest rates are these reins that run down to the 6 horses. And then one day, governments jumped on the 6 horses. It doesn't matter what you do with the reins now. It doesn't matter how hard you pull the reins, because the horses, there's 6 jockeys on 6 horses, 19 horses in the case of Europe. All spurs sticking into the side of the horses and spurring them along. And that's the monetary revolution that's behind us, not in front of us, not a forecast. Now I wanted to just let me run through what I call the Smorgasbord of Repression. So this is part of a bigger thing. I mean, this need to take monetary policy into the hand of government is part of the financial repression. I want to run you through all the policies of financial repression that we've had in the past. And we don't get all of these, but these are the things that governments will do, not might do. They will do these things because they have to hold down interest rates. But this is the question for Europe. Each of you have to make this decision. This policy, as I go through each one of the policies, can that policy be done by the Commission? Or will it be done by each of the 19 states? Because if it can be done centralised by the Commission, then you have a unitary system. You have a unitary monetary system. The unitary monetary system can work. I'm forecasting that we'll have a financial repression in the United Kingdom, but sterling won't break up. We'll have a financial repression in America, but sterling won't break up. If you can conceive that these policies can be implemented in Brussels, what actually happens is Europe comes closer together. So let's go through each of these policies, and you can tell me what you think about whether this can be done by the Commission or whether it's going to be done at the state level. So bank credit control we've already talked about. I can see nothing that the Commission is doing to stop this. or the central bank, because I think they can't do anything. This is emergency measures by governments, and there's no indication yet anyway that the Commission or the government's trying to, or the central bank's trying to stop them. So this one, at least we know, is happening at the local level. It's not happening at the Commission level, and the Commission's not pushing back against it. One of the things we have to do to bring debt to GDP down is a thing called a Capital Issues Committee. So there are two types of debt in any economy. There's bank debt, and there's everything else. And that would be the debt you would find in a BlackRock fund or something like that, money market fund, bonds. If you want to bring debt to GDP down, you're going to have to really restrict the ability of certain people to issue that form of debt. Because remember, you're backing the banks to lend lots of money and create lots of money. So if you're going to bring down debt to GDP, you'd better stop growth in the other portion of debt. Now that's deeply political. Who doesn't get to borrow now? And is that done by the Commission? Arguably, by putting in guarantees on the energy companies, as I said earlier, debt's not available for you guys over here. The banks can only provide so much. Are we really going to have a Capital Issues Committee sitting in Brussels who will determine which companies in Italy get to borrow in the bond market and which companies in Italy don't get to borrow? Or the same for Spain or France? Or is this going to be done at the local level? I'm raising them as questions, but you kind of know what my answer is. I don't think, I mean, given we've been running the European Union for so long, and you know, a certain amount of power is passed to the Commission, the amount of power, political, fiscal, regulatory power that now would need to go to the centre to make this work is huge. It is just a huge constitutional step to pass this to the centre. Transaction taxes on everything except government, well maybe that will be agreed quite quickly, the French like that one. So basically you put a 2% tax on trading equities and a 0% tax on government debt. Therefore forcing people to own more government debt than they would previously choose to. But there may be countries in Europe who don't want to do that. You know, the Germans, why would the Germans want to do that? You know, but anyway, I don't think that can be done by the Commission, but maybe it can. Rent controls. Now we have those in Berlin. We now have those in Scotland, by the way, in case you've missed it, as of last week. We introduced rent controls. People say, well, what's this got to do with financial repression? To get people to buy government bonds, there are two ways you can do that. You can force them to buy government bonds, or you can make everything else less attractive. So one of the reasons that property is attractive is that you can put the rent up. There's an inherent inflation protection in the yield. Therefore, it's more attractive than a bond. Stop it. Take it away. Get rid of the inherent inflation protection in rentals. You turn it into a bond, you make it less attractive. You make bonds more attractive. It's not coincidental that rent controls came after World War II in a period of financial repression. Can the European Commission enforce rent controls in Rome? Or anywhere else in Europe for that matter? Or does that have to be done at the government level? You know, I cannot see how that can be done at the central level. Dividend controls. This was another tool of repression. We have to make equities less attractive than bonds. And why are equities more attractive than bonds? Because the dividend goes up. You know, over the long term, the dividend goes up. If we stop them putting the dividend up, then they wouldn't be any more attractive than bonds. And now suddenly, we get people to buy more bonds. Once again, who in Europe would have that power? I don't think, given the various relationships between government and capital in Europe, that anybody in the Commission could ever have the power to have a universal dividend control policy across Europe. I think that would have to be done by the government. And price controls. Well, we're already getting into price controls in energy. We're getting into price controls to a certain extent with the minimum wage. Could we agree? Well, we're trying to agree at the minute, aren't we? We're trying to agree a universal price for energy. But 19 governments have very, very different views on what that price should be. And the right price that a German can afford may be very different from what someone in southern Italy can afford. Once again, I can't see how that can be done at the centre. Capital controls, the biggest fear of all. I mentioned it earlier. If there's lots of extra money being created by the Italian banking system, will the Germans act to stop it flowing to Germany? And if you force Italian institutions to buy government, just Italian government bonds, force them to sell what they might have left of German and French government bonds, that is a capital control. Could we do that for the whole of Europe? Could the whole of Europe sit down and agree in the European Commission how we stop this capital flowing across border, or will it be a reactionary thing from each of the governments. The Italians won't want to stop creating money. Actually, if I look at the minute, who's the biggest creator of euros in Europe? It's the Germans. The German banking system is it's the second biggest banking system in Europe, but it's the fastest growing at the moment. But I think there are signals there that others will follow. Wealth taxes, would they really be imposed from Brussels? Wealth taxes are an important part of this. If this is moving money from savers to debtors, wealth taxes are a part of that. How on earth could we agree that at the centre? And fiscal creep, the taxation brackets for each of us, and how our higher wages, which are just occurring because of inflation, forces into higher taxation. Another important part of repression. Government or Brussels? I think you get the point. Control of bank deposit rates. This is another important part that we've done with a regulator. In America it was called Regulation Q, and we simply mandated what banks could charge on deposit. Are we really going to have the same mandated rates for German banks as French banks, as Spanish banks, as Dutch banks, as Belgian banks? Because if we're not, we're going to have the decentralization of monetary power. It's going to be the local governments setting interest rates at the deposit level. Restrictions on gold ownership you're familiar with. And then I think the biggest and most frightening of all is central bank digital currencies. Now, I don't think central banks are going to do this. You have a very smart guy in Switzerland who's written a big paper as to why it shouldn't happen. His name is August Carstens of the Bank of International Settlements, warning everybody what the consequence of this is. But if they ignore Carstens, what happens is that everybody in this room chooses to hold the central bank digital currency and the banks have no deposits. Think about what that means. It means that every banker, every commercial banker in this country goes to see the central banker for funding. And the central banker gives them the money on condition that they lend to X, Y, and Z. It's the instant politicization of the flow of credit. It's one of the biggest threats to liberty that I could imagine that this happens, and Carstens has said that this is a huge thing. So I don't think it's going to happen. I really don't. I think it's just too big a jump. But if you start to see central bank digital currencies in size, not limited, but in size, then that's another sign. But once again, €1 euro central currency, one European central bank telling everybody else how much money they get and how they don't get. I mean, the fight within the Eurozone and the EU for where power lies would be automatically stripped not to Brussels, but to Frankfurt, to an unelected part of the European Union in Frankfurt. Not the Parliament, which is elected, not the Commission, which is at least formed from the elected heads of the members of the Eurozone and the EU, but to Frankfurt. So another sign of repression. Other things you need to look out for, and this is more as an investor, ending the deductibility of interest in computing corporation tax. I mean, you do that in Europe today, you agree one rule on that, and the French are in deep trouble and the Germans aren't. Because it's the French who've got huge amounts of debt and are paying huge amounts of interest. So I can't see how you agree with that. Re-equitization is the inevitable consequence of restricting the flow of debt. And then there's the Trustee Act. Trustee Act is something from the United Kingdom. It began after World War I, and we simply went to trustees, fiduciaries, fund managers and said, today 20% is your limit on equities. By law. That's it. That's all you're allowed to own. We consider it to be far too risky for you to have more than 20% in equities. Of course, the real reason they did that is they wanted 80% in government bonds. Because you can actually do this through that. Now we'll just quickly sort of try and wrap up. So I put in a famous chart from Mr. Piketty, Capital. Boris, it's in here somewhere, I'm sure it is. I mean, if you don't have Capital by Piketty in the Library of Mistakes, you're missing the most important contribution to mistakes. But anyway, here's Piketty's chart. On this occasion, it's income distribution, the wealth distribution table. Doesn't look that different. So we began this policy after, well, we began it during World War II. We kept it going after World War II. And you can see what happens to the distribution of income and distribution of wealth. So it works. Now, there are different political opinions in the world. There's a lot of people who think it's time for this. There's a lot of people who vote for it. You know, when I do this presentation on repression, the feedback I get, this is so bad it won't happen. You know, this is the end of the world. I said, it's not the end of the world, it's the end of your world. You know, you are representing savers. The world isn't full of savers. The world's full of debtors. This is a transfer of wealth from savers to debtors. There comes a time in every society, and I think this chart shows it, that time comes. And in democracy in particular, people vote for it. And I think people are voting for it. And this is the consequence of what that means. So, this is big stuff. This is nothing to do with the business cycle. So there you have all my conclusions. Capital controls, people say it's impossible. But of course, we've already had them in Greece and Cyprus. We've had them in Iceland. We've had them in lots of emerging markets. As we sit here today, maybe not today or yesterday, but the day before, the day before, the day before, the day before, capital was pouring out of Europe. Remember, the Eurozone runs a large current account surplus. The Americans run a large current account deficit. One would expect, all other things being equal, that the dollar would be going down and the euro would be going up. But it's actually the other way around. And that tells you that capital is leaving Europe at a ferocious pace. And you have to find the currency that's going up, and frankly, the only one that's going up, really, is the dollar. Why are Europeans moving so much money out of Europe? They're moving it here as well, obviously, to Switzerland. Why are they moving it out? Now, you read an economist, he'll say, well, that's the interest rate differential. The interest rate differential is so attractive that it's luring capital away. It's not. It's because Europeans are frightened of financial repression. They're frightened of that. They know the governments are capable of it. They can see the policies that mean it's coming. And I'm not saying to you that this isn't going to come to the United States, or isn't going to come to the United Kingdom, or isn't going to come to Japan, because I think it is. But it's coming to Europe first. And the great flight of capital we see to Switzerland, we see to America, is really not savers who are concerned about return on capital, but savers who are concerned about the return of capital. And that is driving capital out. So these things are already happening. In my opinion, you can pick the newspaper up every day, and you can see something like this happening. And then you can watch the capital flows, and you can see where they're going and how they're acting, and what's happening. So what do you do about it? I know that's the real reason you came here tonight, to know what we should do about all of this. So I think it's not an equity index product, because the equity index product is full of the winners of the old regime. And this is a completely different regime than before. So there'll be lots of people nodding here. You need to have a value manager to look and pick these stocks on a more value perspective. One thing I haven't talked about tonight is our growing Cold War with China, but that's seemingly now inevitable. That creates lots of opportunities to pick good stocks who benefit from the Cold War with China. There's a turning in what we call the capital cycle in this scenario, where nominal growth is a lot higher than it has been. So, believe it or not, equities, but not all equities, but there are some equities, but it has to be highly selective, highly active, and not passive, and not the index. Gold, of course, is a standout asset for any form of financial repression. I think Japanese equities benefit from our Cold War with China as well. So in conclusion, there are things you can do. And one of the things that comes out of a financial repression and comes out of a Cold War with China is massive capital investment. If I give you the biggest problems that we face, certainly in the developed world today, the answer to all of them is more capital expenditure. What is the answer to the current energy problem? More capital expenditure. What is the answer to our climate crisis? More capital expenditure. What is the answer to the rising cost of wages? More capital expenditure. What is the answer to a Cold War with China? Build more stuff, capital expenditure. And the governments, with their involvement in the banking system, can ensure that that's financed. And they can ensure that it's financed cheaply. And if you're the owner of the equity, then I think there is a bonanza coming for you in terms of cheap government finance to provide all the answers to these political problems. We live in a political world. We've left the age of the market. We're entering the world of control. You're playing a different game. And what you've got to decide now when you buy equity is, are you on the naughty step or are you on the good step? So if you can find that good step, where corporates help solve these problems, then you're lucky. And who's on the bad step? I think it's not difficult to work it out. Goldman Sachs, take that bit out. Now what I mean is investment bankers, people who gear up existing income streams and don't build new income streams. the age, and it's been a 30-year age, where you borrowed money, found an existing income stream and geared it up, private equity or anything else, that age is over. Because the social utility of that will be considered to be too poor. And instead we'll get money going to these guys over here who are going to solve all our problems by building more capital expenditure. So that is, not the answer to where you should invest for the next 15, 20 years, but it's pointing you hopefully in the right direction. And that's the sort of end of this presentation on this problem. But just to reiterate, financial repression is coming everywhere. It's just it causes real problems in a system where you have 19 governments and you're supposed to have central monetary authority. That monetary authority dissolves, we eventually put capital controls in, and the euro doesn't disappear. It's just like what happened when we had Greece and Cyprus. It's still there. We still call it a euro. And in 7, 8 years from now, we realise these things can't be lifted. Because the inflation differential across Europe will be very big. All those 25, 22 years we've been trying to make everybody competitive at the same exchange rate, like grinding and high unemployment in some places. It all gets wasted, it all gets blown away as we get different inflation rates, and these controls can never be lifted. And I don't know when we recognise that one day that means you can't have a single currency, but it'll be there in name, but not in reality. And on the upside, maybe it saves the EU. Because if to go any other direction, I think threatens the EU. So the real thing driving this will be perhaps to try and save the EU by sacrificing the euro. That's it. No, I know there'll be questions.
Do we have time for questions?
I have time for questions, if anybody wants. Yeah, sorry, you were going to ask one.
Yeah, I have a question regarding the expansion of credit by commercial banks by guaranteeing corporate credit. Aren't banks still constrained by Basel III, the leverage ratios?
No, because it's a government risk has a zero risk weight.
So they are considered government guarantees, even they are contingent, they're considered under the risk-weighted assets at 0%.
Yeah, so I mean I'm not a bank analyst, I can't guarantee that, but yeah, basically that's the way it works. It's a government risk, it's not a private risk. Zero risk weighting, or very low, let's just say very low risk weighting.
And wouldn't in that case maybe the euro going into the direction of Japan by the central bank buying all government bonds basically, or owning I think it's 60% of the market, so basically it's not a market anymore.
So there's
doing deal
so there's a problem with this. So we have done that in Japan, and we actually been doing that in Europe, we've been doing it in America, and it looks really easy. So as the central bank balance sheet goes like this, it's just filling up with government bonds. And if we take 2009 to 2019, that happens, and there's no inflation. And the reason there's no inflation is if I track the growth in the supply of money, it's absolutely tiny. Because who's creating money? It's actually the commercial bankers. So as long as the commercial bankers weren't really growing their balance sheets and weren't really creating money, and they weren't doing that from 2009 to 2019, I as a central banker can just keep doing this, cap the yield curve, buy more bonds. That's not the world we live in now. The world we live in now is that commercial bankers are expanding their balance sheets and they're creating money. Now a central banker is supposed to be leaning against the wind. Central bankers are supposed to be putting up interest rates. Central bankers are supposed to be contracting their balance sheet to shrink the amount of liquidity in the system. So we're in a different world now, where it's really highly dangerous for the central banker to use his or her balance sheet to cap the yield curve. So as long as the governments take over that form of money creation, the central bankers are going to have to try and go the other way. That's the great conflict between them. But they absolutely cannot cap the yield curve, because they'll get filled in. They'll get absolutely filled in. Remember when Draghi said, we'll do whatever it takes, I don't know what the Italian bond yields were, probably 6 or 7%, and inflation was close to zero and going down because we were looking at a recession. Then when he said, I'll do whatever it takes, a private sector person would say, well, I can get 6% yield on this, inflation is close to zero. This time when they say we'll do whatever it takes, inflation's at 10. And they're offering to buy everything in, well, for Italy at the minute on the 10-year 4. And they'll get absolutely filled in. So the difference in money creation and inflation is such that the central bank can't do this, or it's very, very dangerous for a central bank to do.
So, if I understand correctly, basically while the central bank could expand its balance sheet via using like government bonds, and I think they're doing already not this operation trees by only buying like
Sure.
Southern Europe bonds, right? If I read correctly, the issue here is that commercial banks guaranteed by their own governments, because they have a zero-weighted asset, could at any moment create credit. So basically, there is no control in the amount. So even if the central bank were to keep expanding the balance sheet, you know, to make this to make place for this, there would be basically the governments on the other side, like pushing the accelerator via guarantees.
You kind of have both of them on the accelerator at the same time, and that's the problem. And you know, what might happen to the euro exchange rate in that situation, regardless of what might happen to inflation. So a central bank is supposed to lean against. Those are the very forces it's supposed to lean against. It didn't have to do that in 2009-19 because those forces weren't there. And now you'd actually be adding to them. So in my opinion, it can't happen. And I guess the other way of looking at it is you know, just how much capital would fly out of a country if you did that. I mean, those two things have really been the, I said nobody will do hyperinflation, but that really is the ingredient for hyperinflation if you do both of those two things at the same time. So I think very, very unlikely. Well, unless you put capital controls in, which you don't want to be around if they put capital controls in. There was a question just behind.
Yep. You've published on the Asian FX crisis in mid-late 90s. Going back to the last point you made about capital flying out of Europe and the negative view of higher interest rate, lower growth, and currency that is depreciating. How similar is the situation today in Europe versus the
Yeah. So
obviously the point you mentioned
Yeah, so
tonight
there's
is
so
even worse.
Well, there's a big difference, and that is the Asians had borrowed in somebody else's currency. So that's the big difference.
Yeah, but because of what you mentioned, that even if European are just like exporting capital,
Yeah.
because they don't want to leave, the fact is the same, right? Is capital staying within
Sure.
the...
So the effect is the same and different. The first thing is it's not good for growth. But the Asians went bankrupt. So you don't go bankrupt in Europe because you couldn't. The Asians went bankrupt because they weren't generating enough dollar income to pay dollar debt. So we don't have that problem. The problem you have is if capital is going out is you don't have enough investment and you don't have growth. And that's the problem that Europe has. And that's why they'll ultimately try to solve it. And there are two ways to solve it. One, stop the capital going out, and two, provide subsidized credit. So I think you get a different answer to this. The Asians of course did massive devaluations of the exchange rate. I'm tempted to say that the euro can't fall that far. It's fallen quite a bit. But you know, the Thai baht can fall a long way. This can't all be done by the exchange rate. I think they will have to do some sort of exchange control to ultimately stop it. I don't know when, but the acid test of when they have to do it is the yield on government bonds. You know, if people are ditching Italian government bonds to buy treasuries, and the yield keeps going up, that's when you're on the life support machine and the thing's going like this. If it does that, that's it. That's when something has to be done. I don't think it's the central bank that does it, and that's when the whole game changes. And the problem for all of us is we don't know what that number is. Is it 4? Is it 4.5? Is it 5? For my clients, I've tried to work that out, not very successfully. We don't know what that number is, but we know that's the number. That is the number when we have to react.
And we know it manifests in higher rates, lower exchange rate.
Yeah.
And there's
What
we recently had, right?
It could come to the United Kingdom before it comes to the EU. We don't know, but the number you have to watch is that yield. And there's a level at which that is politically and socially unacceptable, and something will be done about it. So people who look at markets, I was talking to this gentleman earlier on about why people who study politics and sociology now have a leap on people who study economics. People who study economics will say, well, the rate will just go up until the economy collapses and there'll be a great big crisis. Well, if you're a sociologist or a political scientist, you'll say, no, the rate will go up until they can't accept it anymore and then they'll stop it. It's that line in A Few Good Men, Jack Nicholson, he's being cross-examined by Tom Cruise and he's getting more and more upset and he finally just blows his top and he said, you want the truth? You can't handle the truth. And the truth is the price at which government borrows bonds, borrows money in the bond market. And there is a price which they cannot handle. And that's the time when all of these things happen. So we're now looking around the world to try and work out when is the truth that they can't accept. And then everybody who follows economics is wrong, because they were all working on the basis that the price of government debt would be determined by supply and demand. And it's not. It's not determined by free will. It's not determined by choice. It's a mandated price. And the advantage a historian has is we've seen it all before. We know that that can happen. We've seen it happen, and it will happen again. So it's a really interesting time to be looking at markets, because there's a bull market in the word control and a bear market in the word markets, which means a lot of the analysis we've used in the past, I think, is redundant.
Just to this point, control versus market, couldn't you have said the same 12 years ago and made some very strong points and showed some evidence?
Sure. So I think it's very difficult to know when we get there, right? So we could have said it 12 years ago, because debt then was at an all-time high and debt service ratios were quite high, but it's worse now. So first of all, interest rates got to a very low level. That was one of the ways we got away with it last time. We reduced rates down to 0, but the debt level went higher still, particularly for America, but actually for China. You know, one of the ways we got out of this post-2009 was a huge boom in China. China's debt to GDP ratio is now 290%. I'm doing this from memory now, but it was about 160% in 2007. So I've got a friend who teaches on my course called Jamie Danhauser, and he says, look, the secret of policy for 30 years has been easy. Find another balance sheet to destroy. So there was a card we could play. I don't know when we played it, the Chinese played it, and that was they geared the hell out of the system. They created a lot of growth, and they helped drag the whole world up, but we added more debt as well. So now the question is, which balance sheet is left to destroy to gear us up and lift growth to such a level that we can solve this problem? Suggestions, please. Welcome. So I think that's why we can't do it this time.
Couldn't we have another Plaza Accord 2.0, kind of like to reduce the exchange rate depreciation?
So we need the Chinese to be involved in that. What do you think? The Chinese and the Americans and the Europeans and the Japanese all sitting around a table and agreeing. Not impossible, but seems unlikely. So the Plaza Accord was at a certain time. The Japanese feared that they would have trade sanctions placed against them, and they consented to this. Turns out a very bad mistake by the Japanese, but they consented. I just can't see how we have the geopolitical coordination today to do that. I'd love to be wrong about that, but I don't think we've got it. You know, this is the other thing, because people say, couldn't we rebuild the Bretton Woods Agreement? But we're just not there. You know, the world, Bretton Woods was dictated by the Americans. Americans are strong, but they can't dictate anything today, because they've got China as this huge, powerful force.
Sorry, if you take the repression thinking to its logical conclusion, basically the whole Western world will eventually lock up their savers and their capital inside their borders, and one way to navigate through this is to pick the right stocks, but doesn't it also mean that you have to pick the right jurisdictions?
Yeah.
And it also depends on which jurisdiction you happen to be in. If you're in the US, you have a lot more to choose from.
Yeah.
If you're in Belgium, perhaps you have a lot less to choose from in terms of...
I always tell my clients, with their own money, not their clients' money, with their own money, they must invest a lot in Italy. Because even if you don't get your money back, God, it's a great place to spend it. And you have to begin to think this way again. Where am I going to be spending this money in my retirement? But that was just part of the answer. There are some countries where debt to GDP is so low they probably won't do this, but they're really all in emerging markets.
It's one of the, in addition to your own jurisdiction, where even if you get trapped, well, at least
Yeah.
your expenses lie in that jurisdiction. But
So,
what other ones are
well,
there?
The one, to me, Singapore is top of that list, and that's not a place that you can really invest, but it's a place where you can hold money. India, I don't think will have to take money out. I don't think Switzerland. I don't think Switzerland. Well, not for foreigners.
They charge your capital needs tax.
Yeah, sure, but that's, you can get your money out. And Switzerland, I don't think will have to do this. I was worried that they would have to do it, but the banking system was so huge relative to the state. I don't think Switzerland will have to do it. So there's not a long list, but there's a few lists of places where you can do this.
But do you think the big old US government should also have to resort to that?
Yeah, it holds out longer. Remember that when America went down this road before, it was actually before World War II. It was actually Roosevelt who did this. But quite a lot of Roosevelt's legislation was deemed unconstitutional by the Supreme Court. Now, we all know what sort of Supreme Court America has today. So I think, you know, if the Americans try to do this, I'm sure they'll succeed eventually. But there is a buffer in that Supreme Court, which Europe doesn't have. And we used to think it was the German Constitutional Court. Doesn't seem that it is anymore. So there are no real breaks that I can see on the action of government. There is a break on in Europe. This gentleman's been trying to ask a question for a long time. No?
Okay. I just have a dichotomy between financial capital and productive capital. And you know, what you said, we're talking a lot about financial capital, but in order to get capital expenditure allocated to productive capital, it has to be industrial capital.
Yeah.
And the current geoeconomic situation leaving us with very bad access to resources and so on and so forth, how can we put that capital to productive use?
So I think this is why the word has just changed. This is, I don't know if you're an investor, but there's a thing called the capital cycle. And you've probably got both the books here, have you, Boris? Yeah. Capital account. I'm not going to tell everybody how much it's worth or it might disappear. Capital returns is here as well, written by Marathon Asset Management, and it's absolutely about this symbiotic relationship between financial capital and productive capital, and really how it's broken down. And I've written a lot about how it's broken down. The market seems incapable of fixing it, so the state's going to fix it.
Yeah, but the history has shown that the state isn't very bad at allocating that.
Absolutely. So that takes you, in the long run, that takes you to a pretty bad place.
Yeah.
So I know this, I'm British, so my father used to buy a car called British Leyland. I've never heard of British Leyland. You know, so 30 years before that, we made some of the best cars in the world. Then we did British Leyland. And I spent a lot of my youth pushing it around various bits of Ireland. So yeah, look, in the long run, they misallocate. But in the short run, the return on capital goes through the roof. So I always think of the steel companies, and that gets me into trouble, but you know, European steel companies, what is the return on capital if we don't buy steel from China? Now eventually they get too much cheap capital, or the government does something, and eventually we destroy that. But it's going to take a long time.
Or you have very badly allocated capital like in Eastern Europe, and you produce stuff that doesn't work.
Yeah, and that takes a while.
Yeah, 40 years.
Yeah, it takes a while. So I've no doubt that's where we end up. Because if this was such a wonderful thing, we'd all be doing it already. But it isn't a wonderful thing. But that misallocation takes a very long time. So we've got to get this in the right order. For the United Kingdom, where it ended for us was in bankruptcy in 1976. You know, that was letting the state play too big a role in the allocation of capital. We ended up with the IMF. That was 1976. We're still not, it started in 1945. It takes a while, but you get there in the end. This is the problem with this system. If you go out onto the street and say to people, you know, doing this, because people will like it. Wages are growing at 10, interest rates are 3. Hey, what's not to like? If you go out in the street and say, you know, there's a consequence for this. It's really bad capital allocation. They'll go, because it takes so long. And if you say to a politician, you go, I've got 5 years. That's 15 years. So I completely accept that. But it's just the difference in time horizons. I think it's the difference. Boris, I believe you have beer and wine, is that right? And I'm holding everybody back from that. So in which case, given the beer's getting warm, I just want to, for everybody who's still watching, anybody who's still watching, remember the Library of Mistakes in Lausanne. Go on, register, come, watch the videos, use the books. It's free. What more can I say? Thank you.
In the context of government, why aren't we ever looking at those balance sheets, government balance sheets? We always look at debt to GDP.
Well, the British have sold most of them. I mean, other governments may have things to sell, but we've
I
sold
remember
this.
the Greek, back in 2012, when the Germans wanted to buy some Greek islands. I mean, at one point, it might be a better solution.
Donald Trump wanted to buy Greenland. Remember this?
Exactly, yeah. Is it just something we shouldn't consider?
I mean, you have to work out what the political constraints are, and then within the political constraints, what's possible. Look, selling a Greek island to the French may be acceptable. Selling it to the Germans,
Can you ask you to repeat the names of the two books that you're excited about?
Yeah, so Capital Account
Capital.
and Capital Returns, and they're both edited by Edward Chancellor.
Thank you, sir.
That's
Very
the
interesting.
Capital Cycle. It's the two books. And then, of course, you can come and take my course because we have Edward lecturing on the Capital Cycle.
If the central bank actually continues to expand, and if it doubles again, and the price stays the same, well, it'll be instead of 5 or 6, 2 or 3. So, if gold gets in a way remonetized, it becomes, some people say, oh, it'll become a neutral reserve asset that governments use to settle a block that will maybe de-dollarize when used to settle.
No, yeah, you're right. I mean, I do compare it to GDP. Based on the percentage of GDP historically, it's actually expensive.
Okay.
It's not expensive, it's
Middle of the
clearly
road.
not cheap. If you look at
Compared to equity values, though, it's
yeah, it's pricing.
Focusing more on solutions.